preparing for the 50% world has occupied most of my time in the last few months. And I think, personally, it's probably a psychological issue. I think when we're actually keeping more than the tax man, I think it's the tip of the balance. I don't know if anybody agrees, but it's that point. It's not even the rate anymore. It's, I'm now getting less potentially. When you add on national insurance, it's not really 50%, it's a bit more. We've been talking about lots of things that you can do before the 50% comes in April. But actually, what do you do afterwards? We're talking about deferring income, perhaps until such a time as we're able to reduce our tax rate in a number of ways, be it staying in the UK or not. Talking about trusts a bit and looking at how income is taxed in trusts. And talking about investment wrappers. That's something you'll hear me talking about an awful lot. How we put a shell around money to perhaps change the tax treatment or at least defer the tax. Looking at structures that fit today's world. They don't have any sort of high charges or hidden charges or real severe investment restrictions. But you may remember before we had PEPs and ISAs that we had the 10-year qualifying life policy where one saved on a regular basis, but of course if you didn't keep it up, the insurance company generally kept most of your money. They also had very restrictive investment funds off their menu only. We've been developing and hope to launch in early March a 10-year life policy, which is a savings vehicle, which again has minimal charges. We'll do this with an insurance company. It won't be our own product as such. But the tax rules say that if you make regular premiums for at least 10 years at outset, if you have a minimum amount of life insurance cover, and as long as these premiums are regular in nature, for example annually, they could be monthly, the vehicle will have tax deducted, the investments will have tax deducted that's equal to basic rate. But as long as you run it for 7.5 years of a 10-year term, or 3/4 of the term, there'll be no further tax to pay. So for many who no longer want to make pension contributions, perhaps because they're earning in excess of 150,000 or 130 if your employer's making your pension contributions, and therefore will have a restriction on your tax relief, you're willing to forego tax relief in exchange of having something at the end of 10 years that gives you a lump sum, not the more restricted benefits of a pension scheme, then this regular premium policy will suffer tax at no more than 20% as it goes along. At the end of 10 years, it's possible to just leave the funds within the vehicle or to draw in part. And again, any invested funds will have tax paid at source by the insurance company. So it's just an alternative, and what we have done is created a number of investment strategies that it can link to. Once the fund reaches a certain critical mass, then there can be a complete bespoke investment portfolio run for the individual within this tax efficient wrapper. You're going to see a lot of insurance companies in the next few months dust off this old thing that was called a MIP, Maximum Investment Plan, and it's a form of old endowment. Look at deferring income if indeed you can't take advantage of advancing income into the current year. Do look at hot wrapping your investments efficiently. You may end up paying the same tax rate, but if nothing else, you have control of the tax point. If you pay the tax, there's nothing you can do about it. I should add that all of the ideas I've talked about are completely in the benign section. There is nothing there that is going to upset HMRC, and it is really just sensible planning.